A convoy of U.S. trucks carrying $2 billion worth of goods idles at the Canadian border. Customs officers shake their heads. Not today. This isn't a clerical error. It's a statement. Canada just tightened import restrictions on key U.S. exports, energy, agriculture, and steel. Washington is furious. This isn't just about tariffs or a trade tiff. This is economic brinkmanship between two of the world's largest trading partners. According to the U.S. Census Bureau, Canada accounts for nearly 15% of all U.S. exports, totaling $356 billion annually. Disrupting this relationship isn't just painful, it's potentially catastrophic. But here's what no one's asking. Is this a calculated power play, or is Canada backed into a corner? And more importantly, who breaks first? In a move that shocked Wall Street, Ontario slapped a 25% surcharge on U.S. energy imports, specifically targeting electricity and natural gas. Why does this matter? Because nearly 20% of New York and Michigan's energy supply comes from Canada. The Financial Times estimates that U.S. utility costs in affected states could spike by as much as 30% in the coming months. Ontario's Premier, Doug Ford, defended the move, calling it a necessary response to Washington's aggressive tariff policies. But critics argue that this could backfire, as American lawmakers now threaten retaliation against Canadian exports, including lumber and auto parts. But the bigger question is this just the first domino to fall? Because if other provinces follow suit, this could escalate into something much worse. Trump's administration doubled tariffs on Canadian steel and aluminum to 20%, citing national security concerns. Canada responded instantly. Prime Minister Justin Trudeau unleashed $16.6 billion in counter tariffs, targeting U.S. steel, aluminum, maple syrup, and whiskey, industries critical to Trump's voter base. According to Bloomberg, U.S. steel manufacturers saw a 12% dip in exports following the hike, while the cost of raw materials for American auto manufacturers surged. General Motors and Ford, already under pressure from supply chain disruptions, warned that vehicle production costs could rise by $500 per car, a blow to consumers and an industry struggling to stay competitive. The irony? This was supposed to bring jobs back to America. Instead, it's squeezing U.S. manufacturers, and Canada's latest move just made things worse. Markets hate uncertainty, and the U.S.-Canada trade war just sent investors into panic mode. Following Canada's latest retaliatory tariffs, the Dow Jones Industrial Average fell 410 points, while the S&P 500 dropped 1.6%, wiping out nearly $350 billion in market value. JP Morgan analysts warned that continued escalation could shave 0.3% off U.S. GDP in 2025, while the Canadian dollar fell to its lowest level against the U.S. dollar in 8 months. Who wins here? Not the stock market, not consumers, and certainly not businesses reliant on smooth cross-border trade. But while investors are jittery, Canada's new leader might be the wild card in all of this. Enter Mark Carney, a former Goldman Sachs banker and ex-governor of the Bank of England, and Canada's new Prime Minister. Carney is no politician. He's an economist with a reputation for outmaneuvering financial crises. The Wall Street Journal called him one of the most skilled financial minds of his generation. And now, he's going head-to-head with Trump. In his first speech, Carney didn't mince words. Canada will not be bullied into economic submission. But does he have the leverage to back it up? Because while Canada controls 50% of U.S. lumber imports and nearly 80% of its aluminum supply, the U.S. holds a monopoly on advanced semiconductors, a key lifeline for Canada's tech industry. This trade war isn't just about tariffs anymore, it's about economic survival. And with Carney and Trump both refusing to blink, the next move could determine the future of U.S.-Canada relations. It started as a half-joke at a campaign rally, but Trump's remarks about Canada joining the U.S. sparked an unexpected firestorm. While some brushed it off as campaign theatrics, others noted that U.S. policymakers have discussed deepening economic integration, with some economists arguing that a North American economic bloc could rival China. But let's be real. Canada isn't signing up for statehood anytime soon. The real story? Canada is actively distancing itself from U.S. economic influence, exploring new trade deals with Europe, the Middle East, and China. In fact, Canada just signed a $13 billion energy deal with the UAE, bypassing U.S. dependency entirely. So while Trump's rhetoric makes headlines, Canada is quietly rewriting its economic playbook, and Washington might not be ready for what's coming next. Canada's trade war isn't just a federal issue. Its provinces are now making their own economic moves. Alberta, one of the world's largest oil producers, just announced a potential restriction on crude exports to U.S. refineries, targeting states like California and Illinois that rely on Canadian heavy crude. If enforced, this could drive up U.S. gas prices by as much as 15 cents per gallon, according to Bloomberg analysts. Meanwhile, British Columbia has intensified its environmental policies, delaying U.S. coal exports through its ports, which handle nearly 36 million metric tons annually. In retaliation, Montana and Wyoming lawmakers are considering lawsuits, claiming Canada's restrictions violate NAFTA's successor, the USMCA. Ontario is also playing hardball. Its government is cutting contracts with American infrastructure firms, diverting billions in planned U.S. investments into European and domestic suppliers instead. As these provinces escalate the trade war independently, the question becomes, is Canada still a unified economic front, or are regional leaders taking matters into their own hands? British Columbia's decision to limit U.S. coal exports is more than just an environmental stance. It's an economic weapon. As the largest export hub for U.S. thermal coal, BC handles nearly 80% of America's West Coast coal shipments, according to the Canadian National Energy Board. If these restrictions hold, U.S. coal producers stand to lose an estimated $3 billion in annual exports, primarily to Asia. Arch Resources, one of the largest U.S. coal companies, saw its stock drop 6% following BC's announcement, as investors anticipated major logistical disruptions. The American Association of Railroads warned that halting coal shipments through Canada could reduce U.S. freight traffic by up to 10%, further straining an industry already hit by supply chain issues. While environmental groups applaud BC's move, U.S. coal lobbyists are pressing Washington to retaliate, demanding tariffs on Canadian lumber and minerals. But with global demand for coal rising, China's coal imports surged 13% in 2024. Could this actually end up benefiting U.S. rivals like Australia and Indonesia instead? Canada's latest economic retaliation strikes at the heart of America's auto industry, worth over $1.2 trillion. Ontario, which supplies over 40% of U.S. automotive parts, has hinted at new export restrictions, potentially delaying shipments of critical materials like lithium-ion batteries and semiconductors. General Motors and Ford, which source up to 70% of their aluminum and steel from Canada, are already warning that these supply chain disruptions could increase vehicle costs by $1,500 per unit. The Detroit Free Press reported that auto suppliers in Michigan and Ohio are bracing for layoffs, with some firms already planning plant shutdowns if parts delays extend beyond Q2 2025. Meanwhile, Chinese and European automakers are watching closely, as any sustained delays could push North American consumers toward electric vehicle imports. The bigger issue? If Washington and Ottawa fail to reach an agreement, could this be the moment that permanently weakens America's auto dominance? With over $800 billion in annual trade between the U.S. and Canada, prolonged retaliation could have catastrophic consequences. The Bank of Canada warns that sustained tariffs and export restrictions could shave 0.6% off Canada's GDP in 2025, while the Congressional Budget Office estimates that the U.S. economy could lose up to 125,000 manufacturing jobs if the trade dispute continues into 2026. The biggest risk? A currency war. The Canadian dollar has already fallen 5.3% against the US dollar since tariffs began escalating, making Canadian exports cheaper, but also driving up import costs for US businesses reliant on Canadian materials. Energy markets are also reacting. West Texas Intermediate crude prices jumped 4% in February after Alberta's threats to restrict oil exports. If both nations remain locked in this standoff, credit markets may tighten, consumer prices could rise, and foreign investors might pull back from North American assets. So, is this just another trade battle? Or are we looking at the first signs of a North American economic downturn? The stakes couldn't be higher. Despite rising tensions, the US and Canada remain each other's largest trading partners, exchanging nearly $2.2 billion in goods daily. But with relations deteriorating, multinational corporations are now reevaluating supply chains, moving production to Mexico, Europe, and even China. According to Bloomberg, Tesla and Apple are already shifting key component sourcing away from North America to avoid tariff risks. Meanwhile, trade negotiators on both sides face mounting pressure from industry leaders and political factions. U.S. business groups are urging Washington to back off tariffs, while Canadian unions demand retaliatory policies to protect domestic jobs. The Bank of America estimates that a full-scale trade war could reduce global GDP by nearly 0.4%, a $320 billion hit to the global economy. The next 6 months will determine whether this is a temporary political standoff or a long-term shift in economic alliances. But with tensions still climbing, is a diplomatic resolution even possible, or has irreversible damage already been done? If the US and Canada, two of the most economically integrated nations, can spiral into a trade war, what happens next? Analysts at the World Trade Organization warn that these tensions could encourage other nations to erect their own economic barriers. China, already locked in its own trade battles with Washington, has strengthened economic ties with Canada, signing a $13 billion energy deal just as U.S.-Canada relations soured. Meanwhile, the European Union is closely monitoring the situation, as key industries, from aerospace to agriculture, brace for potential ripple effects. If trade protectionism continues to spread, it could fracture global supply chains, disrupt investment flows, and drive inflation even higher worldwide. The IMF projects that an expansion of trade conflicts beyond North America could slash global economic growth by 1.2%, a loss of nearly $1 trillion annually. So, as trade disputes multiply, the real question isn't just whether the US and Canada can mend their fractured relationship. It's whether the global economy can withstand a new era of economic nationalism. This isn't just about tariffs, surcharges, or retaliatory policies. It's about whether the world's most stable trade alliances are breaking apart before our eyes. If this conflict continues, entire industries could be reshaped, global financial markets could face serious shocks, and consumers worldwide will feel the consequences. But what happens next? Will the US and Canada back down, or are we witnessing the beginning of a permanent economic realignment? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.